Welcome back to the Deep Dive. Today we're tackling a topic that can seem pretty dense at first glance. The principles of consolidated financial statements. I mean, you look at these huge multinational companies, right? Your Amazons, your Apples. Their financial reports aren't just about one single company. No, they're this carefully stitched together picture of maybe hundreds, even thousands of separate legal entities all over the world. So the big question is, how do they actually do that? How do they take all these distinct businesses and combine them into one coherent report? That's our mission today. To quickly get under the hood of the rules, mainly IFRS 10, that say when and how this has to happen.
Yeah, and it all boils down to a really fundamental idea, actually. It's about showing the economic reality, the substance, rather than just the strict legal setup. If a parent company genuinely controls another one, well, the financial statements need to show that unified picture. It doesn't matter so much what the individual legal papers say. The goal here really is to give anyone reading those reports a clear view of the whole group's resources, its debts, and, what it actually achieved together.
Okay, let's break that down. You mentioned a group. What actually constitutes a group in this context? What are we looking for?
Right. So basically, a group has two main parts. A parent company, let's call it P, and at least one subsidiary. SP is the one in charge, the controller. S is the entity that's being controlled. Now, legally speaking, P and S are totally separate. They might have different boards, file different tax returns, all that.
But for financial reporting.
Exactly. For reporting, they're treated as if they're just one single economic unit.
And how do we know if that relationship exists? Is it just about owning shares?
Well, historically, yeah, the main test is pretty simple. Did P own more than over 50% of S's voting shares? That usually did the trick.
But you said historically. It's more complicated now.
Oh, definitely. Modern business structures are way more sophisticated. So now, owning over 50% is a strong indicator, sure. But it's not the only thing. We also have to look at operational influence. Does P have the power to appoint the key directors at S? Can P essentially run S like it's just another department, making the big operational calls? That kind of practical control matters hugely.
Right. So it's less about the legal lines on a map and more about who's actually steering the ship.
Precisely. The focus shifts.
So for people using these statements, analysts, investors, lenders, the consolidated report aims to show all the resources the group controls, all its obligations, and the combined bottom line.
That's it, exactly. It's about presenting the whole economic entity, the whole organism, you might say.
Not just looking at one company within the structure that might look healthy on its own.
Right. You get the full picture, warts and all. This ensures that when you're assessing, say, the group's overall risk or its profitability, you're seeing the complete story.
Okay, this is where I think it gets really interesting. We're moving beyond that simple 51% ownership idea into the nitty-gritty of control, as defined by IFRS 10. You said it's the sole basis for consolidation.
That's right. IFRS 10 really changed the game. It moved away from bright-line ownership tests to a more principle-based approach. For control to exist under IFRS 10, you need three specific things to be present, all three together.
Okay, what are they?
First, the investor, the potential parent, needs to have power over the investee, the potential subsidiary.
Power. What does that mean in practice?
It means having the current existing ability to direct the activities that most significantly affect the investee's returns. Think strategic decisions, major operating policies, capital budgets, the stuff that really moves the needle.
Okay, so the ability to call the shots on important matters. But just having power isn't enough on its own, is it?
No, absolutely not. You could have power over, say, a nonprofit you volunteer for, but you wouldn't consolidate its finances into yours. That brings us to the second element. The investor must have exposure or rights to variable returns from its involvement.
Variable returns, so not just a fixed interest payment or something.
Exactly. These returns have to fluctuate based on how well the investee does. They could be dividends, maybe profit shares, management fees that depend on performance, even potential losses that the investor might have to absorb. The key is variability.
And that variability point, that sounds crucial. I remember hearing that this was partly a response to some of the complex structures companies used before the financial crisis, like special purpose entities.
You've hit on a key piece of history there. Yes, the standard setters realized that companies were setting up entities where they might not have majority ownership, but they were definitely exposed to the ups and downs, the variable returns, often while keeping debt off their own books.
Sneaky.
Well, IFRS 10 aims to capture that economic reality. If you stand to gain or lose significantly based on performance, you're acting like an owner, even if the share register doesn't scream majority owner.
Okay, so power to direct and exposure to variable returns. What's the third piece?
The third element ties the first two together. It's the ability to use its power over the investee to affect the amount of the investor's returns.
Ah, so it's not just having power and getting returns separately. You need to be able to use that power to influence the returns you get.
Precisely. It's about the linkage. Can you make decisions using your power that will likely increase your dividends or perhaps cut your losses? It's that active connection.
And figuring out if someone has power can be tricky, right? It's not always just about votes.
Absolutely. Assessing power requires looking at all the facts and circumstances. It gets nuanced. For instance, maybe you only own 40% of the voting shares, but what if the other 60% is spread thinly among thousands of tiny shareholders who never vote or coordinate?
Then your 40% might effectively be total control.
Exactly. That's de facto control. You have the practical ability to direct things. We also have to consider potential voting rights.
Like options.
Yes, things like share options or convertible debt. If you hold options that are currently exercisable, meaning you could buy enough shares today to get control and it makes economic sense for you to do so, then you might be considered to have power now, even before you exercise them.
Wow, okay. So you really have to look beyond the surface.
The standard forces you to. It's about the ability to control right now.
Makes sense. So once we've established that, yes, control exists and this group needs to consolidate, what are the actual mechanics? What are the technical hoops accountants need to jump through to make sure the final combined statement is reliable?
Good question. The first big hurdle is ensuring consistency. It's called the requirement for uniform accounting policies.
Meaning everyone in the group has to account for the same things in the same way.
Pretty much, yeah. For similar transactions and events, everyone has to use the same accounting rules. So if the parent uses, say, FIFO for inventory, but a subsidiary uses weighted average, the subsidiary's numbers have to be adjusted to FIFO before they get consolidated.
Otherwise, you're adding apples and oranges.
Exactly. You need that uniformity for the consolidated figures to mean anything.
Okay, standardization. What else? What about timing? Global companies might have subsidiaries ending their financial year at different times.
Ah, yes, the non-coterminous year-ends problem. Very common. The main rule is straightforward. Ideally, the subsidiary's reporting date should be the same as the parent's.
But that's not always practical, I guess.
Not always. So IFRS 10 allows a bit of flexibility. If it's really impractical to align the dates, the subsidiary's existing financial statements can be used for consolidation if their year-end is not more than 3 months different from the parent's year-end.
3 months. So if the parent is December 31st, a subsidiary ending September 30th could potentially use those figures.
Potentially, yes, or even March 31st of the following year. But there's a big but.
Ah, always a catch.
You must make adjustments for any significant transactions or events that happen in that gap period between the subsidiary's year-end and the parent's year-end.
So if the subsidiary bought a huge asset or settled a major lawsuit in November, that has to be reflected in the December 31st consolidated statements.
Absolutely. You can't just ignore major events in the gap. The consolidated picture has to be fair as of the parent's reporting date.
Okay, uniform policies, dealing with different year ends.
Mm-hmm.
Then there's the internal stuff, right?
Yeah.
The transactions between companies in the group.
Yes, the cleanup process, as you called it earlier, that's the elimination of intragroup transactions. This is crucial.
Why is that so important?
Well, imagine parent P sells goods worth $5 million to subsidiary S. From P's perspective, that's revenue. From S's perspective, that's inventory or cost of goods sold eventually.
Right.
But from the perspective of the group as a single economic entity, has any real external transaction occurred? Has the group as a whole made a sale to the outside world?
No, not yet. The money just moved from one pocket to another within the group.
Precisely. So when you consolidate, you have to cancel out that $5 million internal sale and the related profit sitting in inventory until S sells it externally. You eliminate all the internal stuff, revenues, expenses, profits, and assets like inventory, receivables, and payables between group members. If you didn't, you'd be double counting or just inflating the group's apparent size and profitability massively.
It really shows how much work goes into creating that single, unified view. Okay, now let's talk about getting out of this. Are there situations where a parent company doesn't have to prepare these consolidated statements, or maybe where they can leave a specific subsidiary out?
Yes, there are exceptions, but it's important to distinguish two different things here. First, there are rules about when a parent might be exempt from preparing consolidated statements altogether. Second, there are very specific reasons why a parent might exclude a particular subsidiary from consolidation, even if it generally has to consolidate others.
Okay, let's start with the first one. Exemption from preparing the whole consolidated package. Who gets that pass?
This exemption is mainly aimed at what we call intermediate parents companies that are parents themselves, but are also subsidiaries of an even larger group.
Like a middle manager in the corporate structure.
Sort of, yeah. And to qualify for this exemption, all four of the following conditions have to be met. It's quite strict.
All right, condition one.
1. The parent itself must be a wholly owned subsidiary, or at least partially owned, and its other owners, the non-controlling interests, must have been informed and not objected to the parent not presenting consolidated statements.
So your own boss, higher up, has to be okay with it, and any minority shareholders in your specific company also need to agree, basically.
Essentially, yes. Conditions 2 and 3 are related. The parent's own debt or equity instruments must not be traded in a public market, like a stock exchange, and it must not be in the process of filing statements with a regulator for the purpose of issuing any type of instruments in a public market. This is about protecting public investors.
Makes sense. If the public isn't relying on your statements directly, the need is less critical. What's the fourth condition?
The fourth is crucial. The parent's own parent company, the ultimate parent at the top of the group, must produce consolidated financial statements that comply with IFRS and are available for public use.
Ah, so the information is available publicly, just one level higher up the chain.
Exactly. If the ultimate parent is already providing the consolidated picture for the whole group, including this intermediate parent, then requiring the intermediate parent to do it again is seen as redundant.
Okay, that covers the exemption from preparation. But what about the second scenario? The parent is consolidating, but wants to leave one specific subsidiary out. Maybe it's tiny, or maybe it's just a headache.
Right. Exclusion of a specific subsidiary is only allowed in very limited circumstances under IFRS 10. There are basically two permitted reasons.
Only two. What are they?
First, if the subsidiary is classified as held for resale according to another standard, IFRS 5, this means management is actively trying to sell it, expects to complete the sale within a year, and meets some other strict criteria.
So it's basically already on its way out the door.
Pretty much. In that case, you don't consolidate it line by line. You treat it more like a short-term investment asset on the balance sheet.
Okay, held for resale. What's the second reason?
The second is materiality. If the subsidiary is so small that its financial impact, its assets, liabilities, profits, cash flows, is genuinely insignificant or trivial to the overall group picture, it may be excluded.
But materiality can be subjective, can't it?
It requires judgment, yes, but it's a high bar. We're talking about amounts that wouldn't influence the decisions of someone reading the financial statements, and it has to be reassessed regularly. You can't just deem something immaterial once and forget about it.
So those are the only two allowed reasons.
Mm,
Held for resale or genuinely immaterial.
that's it.
Now, I can just imagine a director looking at a subsidiary that's losing money hand over fist, dragging down the whole group's results and thinking, man, I wish we could just not include this one this year. Are common excuses like that specifically forbidden?
Oh, absolutely. And this is probably one of the most critical points about the integrity of consolidation under IFRS. Directors cannot choose to exclude a subsidiary simply because it has poor performance or a weak financial position. That's explicitly not allowed.
Even if it makes the group look bad.
Especially then. The whole point is transparency. You also cannot exclude a subsidiary just because its business activities are different from the rest of the group. That used to be an excuse sometimes. Oh, this widget maker doesn't fit with our services businesses. Let's leave it out. Not allowed anymore.
So no hiding the problem children or the odd ones out.
None at all. If those kinds of exclusions were permitted, consolidation would just become a tool for companies to manage their reported earnings, to cherry-pick the good bits and hide the bad. IFRS is very clear. If you control it, you consolidate it, period. The economic reality, good or bad, must be presented.
That really underscores the principle of reflecting economic reality, doesn't it? Okay, let's quickly recap. We've seen that consolidation isn't just about owning shares. It's fundamentally about control, defined by IFRS 10 through power, exposure to variable returns, and the ability to link the two. And preparing these statements involves strict rules on uniform policies, handling different year-ends, and meticulously stripping out all the internal intra-group transactions.
Right, ensuring that the final picture represents the group as a single economic unit dealing with the outside world.
And we also learned that the loopholes for not consolidating or for excluding a subsidiary are actually very narrow and specific mainly for intermediate parents under certain conditions, or for subsidiaries genuinely held for sale or truly immaterial ones.
And crucially, poor performance or different activities are absolutely not valid reasons for exclusion. Transparency trumps convenience or presentation.
So thinking about all this, that detailed, mandatory focus on control power, variable returns, the ability to affect returns, consider what that really means for investors and analysts.
How profoundly does this shift towards reflecting economic substance, forced by standards like IFRS 10, change how you evaluate the true risks and real profitability of a complex global company compared to just looking at its separate legal parts?
That's the core question, isn't it? When the accounting rules force companies to bring everything they control onto the main stage, under the main spotlight, it fundamentally changes the game. You can't use complex legal structures quite so easily anymore to shield risks or obscure performance. It forces a level of transparency that reshapes how we understand and measure corporate success itself. That mandated focus on economic substance really does alter the landscape of financial analysis.